Hello traders. The title of the video is First Step to Mastering Common Price Structures in the Financial Market, Part 1. Alright, so I'm starting today a series of videos about first step to about mastering common price structures in the financial market. So this is the first video. I will be recording probably 4 videos in this series of video, because if it's too long, if I have too many videos in that series of video, trader will get tired of it. So I will record probably 4 videos. I want to speak to other traders that did ask me to record video about short-term trend, okay, medium-term trend, and so on. And I already posted a video about short-term trend. I'm working on the medium-term trend, so do not think that okay, I'll put you aside. We'll come back to those discussions, okay, in the very near future. All right. But for now, let's begin our discussion about the first step to mastering common price structures in the financial market, part 1. All right. So a lot of advanced traders, more experienced traders, already know most of those common price structures. But I want to touch a few things that a trader must know. And also, we don't want to forget those who are new in the financial market that are learning, okay, to trade on the financial market. So if you already know it, all right, so stay with us, okay, and watch the video, and maybe you get something out of it. But if you already know it, don't mark it down because you know it about it already. All right? Don't mark it down just because you already mastered it. All right. The first step, mastering common price structure. The first common price structure that a stock trader, a financial market trader must know is that if a financial instrument is trending, earlier we trader know about a trending multi-way is trending. So here this stock did trend from here 2003 up to 2008 did trend, right? And after the trending phase, okay, there will be a correction. This is a harvest. So people do not buy the stock forever. So for those who are buying and hold, understand that there will be a harvest time, and people will talk about bearish season. It's not bearish as such. People are just taking profit because the natural progression of the stock market, the financial market, is up. People want the stock to go up, all right? So they appreciate that their capital to make more money, all right? So, but there will be a time when there will be profit taking. For area way trader, they talk about correction, all right? Correction. So talking about common price structure is that if we have a trending phase and the correction is a sharp correction is very fast. You see here, 1, 2, 3, 4. In 4 months, the correction is finished. That's very fast for a correction. A correction can take a year, 2 years, even 5 years. Some stock can take 5 years to complete. But here it is, a correction within 5 months is done. If the correction is a sharp correction, which means price goes down vertically like this, and it brings the price to the 78% Fibonacci retracement level, there will be buyers. So if you are in the stock market, all right, you are trading, you are investing, you want to understand that common price structure. So traders say, is that all? To a certain degree, yes, but we're going to say more. Understand that. Trending first, sharp correction. If you bring the price here, there will be demand to buy. People will be willing to buy. So you have to draw a line there. A priority to bullish signal above, a priority to bearish signal below it. So you can just watch the reaction or wait for the first higher low above that 78% level, because it's a sharp correction. They quickly bring it there purposely. All right, doesn't happen just by mistake. Purposely, they push it down there. What usually takes place here, after the price reaches that level, right, there will be a bounce. Price will bounce up a bit, will bring the price to the 50% Fibonacci retracement level, or this mush of the sharp correction. So this is the sharp correction. If you apply Fibonacci, okay, retracement to that sharp correction. All right. So I'm applying Fibonacci retracement to the sharp correction. When people start buying at a 70%, 78% Fibonacci retracement level, there will be that bounce, bringing the price where you will see here. That's the 50%. You see 50 on my chart, 50% Fibonacci retracement level. Doesn't always, not always the case, but very often, that's what you will see. That's the first expectation. Price may do something else, but that's the first expectation. So price will bounce from here, go to 50%, and then you will try to pull back. Generally, if the market want to start on the strong foot, so to speak, all right, you want to have a strong foundation, they will pull it back from that 50% back to the 78% Fibonacci retracement level to form a beautiful, gorgeous, okay, a bullish chart pattern here. A double bottom chart pattern, right? Right? So this is one of the common price structures a financial market trader or investor must know. That's it. Trending first, sharp correction bring the price to 78% Fibonacci retracement level. You, as a market participant, you want to understand what's going through the mind of a market participant. They want to buy in that zone. But be careful. Sometimes the price may break below it, as I show you in one of the video already. All right, may break below that level and go down. So don't just assume that definitely you're going to turn around. But generally, it usually turn around there because that level is considered as oversold. If the price start going up, people are watching a 50% Fibonacci retracement level, or this move down. Here it is. You see, happen here, and then they try to pull back. This is a quite bullish stock because they push it back quickly up. Usually they will prefer to bring it back here to form the bullish chart pattern, all right, back here, and then before it goes up. So you want to understand that. I'm not talking about normal correction, bringing the price here. I'm talking about a sharp correction, bringing the price here. Next thing that I want to add to this tutorial today, before we wrap it up, is this. If the price continue to go after reaching the 50% Fibonacci retracement level of the sharp correction, if you pull back like it did here, start going up, the next level that it has a high chance to find a resistance is the 78% Fibonacci retracement of that sharp correction. So whenever you see a sharp correction like this, mark down the 50% and the 78% Fibonacci retracement level. Most of the time, you will have people here waiting to sell, people waiting at 78% Fibonacci retracement level to sell. If you have just a sharp correction, so you may say, Joe, you're talking about sharp correction. It's because the reason why I'm doing it on purpose, because if you forget that I'm talking here specifically about a sharp correction, and you just take it as a normal correction, it can be a misinterpretation of what I'm trying to explain here. All right. So this is it. Very simple, and one must know it. Alright, so you do not step on the foot of the professional trader. So you can see at 78% there is again a reaction. Yeah, alright. At 50% we see the reaction. At 78% there is a reaction. Alright. I talked about the normal correction before, but I don't want to talk about it in this tutorial. This is about mastering, first step to mastering common price structure in the financial market, part 1. If you have any question or suggestion, please feel free to put in the comment section. I always read the comment, and of course I will be recording another video to answer your specific question. If you find this video truly useful, whether you are experienced or new trader, let us know by giving us the thumbs up. If you think that, George, I'm not very sure, you have not done a good job today, mark it down, and that will put us under pressure to improve our next recording. Again, this is an essential tutorial. Feel free to share it on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about first step to mastering common price structure in the financial market, part 1. See you in part 2.